In this video, you will learn about income, credits, and deductions, three key components that determine your tax outcome. Let's begin by reviewing common income forms, then we'll break down tax credits, followed by deductions, and finish with a comparison between credits and deductions, an explanation of adjustments to income, and how AGI, adjusted gross income, impacts your taxes. The first income form is Form W-2, Wage and Tax Statement. This form is issued by employers to report annual wages and the taxes withheld from your paycheck. It includes federal, Social Security, Medicare, and applicable state and local tax data. Most employees will receive a W-2 for every job they held in a calendar year. Form 1099, Non-Employee Compensation, used to report payments of $600 or more to independent contractors, freelancers, or gig workers. Unlike W-2 employees, recipients of this form are responsible for their own taxes, including self-employment tax and estimated tax payments. Form 1099-Miscellaneous Income. This form covers income that doesn't fall under the usual categories, such as rental income, prizes, legal settlements, or royalties. It is often used by businesses to report other types of non-employee payments. Form 1099, Interest Income, issued by banks or financial institutions to report earned interest of $10 or more. If you hold a savings account, certificate of deposit, or bond, this form reports how much interest you've earned during the tax year. Form 1099, Dividends and Distributions. This form is used to report dividends paid by stocks, mutual funds, or other investments. It helps determine your investment income and whether it qualifies for special tax rates based on whether it's ordinary or qualified dividends. Form 1099-G, Government Payments, reports certain types of government income, such as unemployment compensation, state tax refunds, or agricultural payments. This form is essential when accounting for government-based income or refunds. Form SSA 1099, Social Security Benefits, sent to individuals receiving Social Security benefits. Depending on your total income and filing status, a portion of your benefits may be taxable. This form helps calculate how much should be included in your tax return. But professional preparation is typically offered for profit. Schedule C, Profit or Loss from Business. Schedule C is used by sole proprietors and single-member LLCs to report income and expenses from a business or self-employment activity. It is filed along with the individual's Form 1040 tax return. On Schedule C, the taxpayer lists gross income, which includes all earnings from the business before any expenses are deducted. Then, allowable business expenses, such as advertising, supplies, rent, mileage, and more, are subtracted to calculate the net income. Gross income equals total business revenue before expenses. Net income equals gross income minus business expenses. The resulting net income is what the IRS uses to determine the individual's taxable business profit. This amount is also used to calculate self-employment taxes. Schedule C is essential for accurately reporting how much a self-employed individual actually earned after operating costs. Tax credit forms and their uses. Schedule 8812, Child Tax Credit, used to claim the child tax credit for qualifying children under age 17. It includes a refundable portion called the Additional Child Tax Credit, which may result in a refund even if no tax is owed. Form 8863, Education Credits. This form allows taxpayers to claim credits, such as the American Opportunity Credit, up to $2,500 per student, and the Lifetime Learning Credit. It helps reduce taxes for those paying higher education expenses. Form 2441, Child and Dependent Care Expenses. This form is used to claim a credit for child care or dependent care expenses while you work or look for work. It helps offset the high cost of care for dependents. Schedule EIC, Earned Income Credit, filed when claiming the Earned Income Credit for low to moderate income individuals and families. This refundable credit can significantly increase refunds and supports those who meet income and family size qualifications. Deductions and their purpose. Student loan interest deduction. You may deduct up to $2,500 in interest paid on qualified student loans. This adjustment reduces your taxable income and can be claimed even if you do not itemize deductions. Medical and dental expenses. If you itemize, you can deduct unreimbursed medical expenses that exceed 7.5% of your AGI. This includes doctor visits, prescriptions, surgeries, and other necessary treatments. Mortgage interest deduction. Homeowners can deduct interest paid on a mortgage. This itemized deduction can reduce taxable income significantly for those with home loans. Charitable contributions. Contributions to qualified charitable organizations may be deductible. Cash donations and the fair market value of donated property can help reduce your taxable income. State and local tax deduction. You can deduct up to $10,000 in combined property taxes and either state income tax or sales tax. This deduction is only available when itemizing your deductions. Credits versus deductions. What's the difference? Think of deductions as reducing the amount of income you're taxed on, and credits as directly reducing your tax. Let me explain using a scenario. Sarah earned $50,000 in a year. A $2,000 deduction reduces her taxable income to $48,000. However, if Sarah gets a $2,000 credit, it reduces her actual tax due by $2,000, dollar for dollar. Adjustments to income and understanding AGI. Adjustments to income are certain expenses that reduce your gross income to arrive at your adjusted gross income, AGI. These include things like student loan interest, HSA contributions, and educator expenses. AGI is your gross income minus these adjustments. It plays a critical role in determining your eligibility for credits, deductions, and even whether certain income types are taxable. Let me explain using a scenario. David earns $60,000 in gross income. He pays $2,000 in student loan interest and contributes $3,000 to an HSA. His AGI would be $55,000. This AGI will determine his eligibility for tax credits, deductions, and other IRS thresholds. In this video, you learned how to identify and interpret common IRS income forms, credit forms, and deductions. You also gained insight into how AGI is calculated and why it matters, along with how to distinguish between deductions and credits through real-world scenarios. We hope you found this video helpful and feel more confident navigating the basics of income, credits, and deductions.